like most people, I'm not expecting the Fed to say much this week. They've been very clear that they're watching two things. Number one, inflation, and number two, employment. And so we have not been kind of meeting the Fed's smell test, if you will, on the employment. We do have this disconnect in terms of available jobs and then people who are unemployed. So we're not really meeting their requirement there or their threshold to be able to act. So I'm not really expecting much. And that one of those sound bites was absolutely right. I was listening, so I couldn't see. But you don't know if inflation is transitory until we're really through it, like in it and through it. But I do think that we have to consider that we're bouncing back from such a low point of growth, and so when you bounce, you're really having this surge of growth in prices. And so, the current inflation really reflects that upward momentum. So, I think that we are going to be in this bounce back for a while. So investors should be thinking about how they're positioning their portfolios. The best positioning really to kind of weather any scenario is a diversified portfolio. Thinking about diversification across size and style, even slightly overweighting growth as a hedge for inflation, but also including value, which is clearly having a moment. And then in addition to large cap, small cap opportunities, investors can also add global equities, from countries that aren't necessarily, in tandem with U.S. inflation. They can be a hedge to domestic inflation. And, for those people who are maybe closer to retirement or just really income investors, and a little bit more conservative, also adding tips as well.
Yeah, I mean, it's amazing. You look at 10-year yields, Tiffany, and I tweeted last night, just kind of, ruffle feathers. I said I thought the 10-year yield would end the year under 1.5%. Nobody cares what I think. They care what you think as well. We are below 1.5% of the 10-year. Does that give the all clear to big tech stocks? A name by the way, I know you like from watching Halftime Report and everything else. A Microsoft, maybe a Netflix?
Yeah, well, I mean, as you mentioned at the top of the show, the NASDAQ is really having a moment. It really is in this, the seventh straight positive day. And so, we did have that rotation kind of into value, but I think that we are going to be having this rotation back into growth before the end of the year. I think that we're seeing that right now. And I like Microsoft for a number of reasons, including, they just announced their streaming offering, which I think they're really uniquely positioned to kind of dominate in the gaming streaming space. But yeah, I do think that kind of opens the way for tech to kind of do its thing and kind of reclaim its spot, if you will.
Yeah, because low rates going to be certainly a key to that as well. And when you say around the world, very quickly, do you think European markets, which to coin a phrase, are having a moment, Tiffany? Are European equities overall a better bet than U.S. equities?
So you won't get me to say better, right? So I would say, again, going back to this idea of this diversified portfolio, I think including European equities is definitely a good idea. Also, in particular, Italian equities, right? So Italian countries like Italy and Australia their inflation doesn't seem to be in lockstep and in tandem with U.S. inflation. So I think that that's a good idea too.
Shepard Smith here. Thanks for watching CNBC on YouTube.